All right, good morning, everyone. Thank you for joining us this morning for our webcast on retirement plan risks in the nonprofit sector, on how to manage um, effectively in the retirement plan that you have and avoid the risks as you are a part of the volunteer board of such nonprofit sector. My name is Kinman Tong, and I'm a partner with Moss Adams. I am part of our nonprofit and healthcare services group, and I do lead our FQHC and community health center sector. And and then we'll have my fellow presenters introduce themselves as well.
And my name is Bertha Minahan. I'm an audit partner with Moss Adams, and I specialize in employee benefit plan and retirement plan audits, and really excited to be here. Eric?
And I'm Eric Daly. I'm managing principal with Multnomah Group, working with tax-exempt plan sponsors to help improve the quality outputs of the retirement plan while minimizing risks to committees and boards.
Great.
We are super excited to essentially, work with Eric and the team at Multnomah Group to kind of cover this topic. And what we would like to start with is a couple of polling questions. And the first one that I'll cover is, what industry are you representing? Because our tax-exempt nonprofit sector is pretty wide. So, please pick one of this option. And if you're not represented in one of the polling option, please put in the chat who you represent as well. We give everyone a couple more seconds before we kind of close the poll. All right.
Ooh.
Yeah. So most of you are just straight tax exempt nonprofit organizations, some healthcare, some education institution, and then the handful of you who are others, definitely please will drop in on the chat what else you represent, and we can address specific questions around that as well. Bertha, you want to take us to the next polling question?
Yes. So now we're going to get a little more detailed on you all that are joining us today to see what role you represent in your organization. So let us know if you're in finance or human resources or a combination of plan committee and a function or board member. So it's always good to know the different hats you're wearing. Because as we know today, that's why we're here. We wear really different hats in serving our employees and our organization. So it's usually cool to know. And you might have served in other roles in the past. That's Kinman and I have seen this, and I'm sure Eric has as people move around. That's always fun too, to have different roles in the organization. So we will leave this on for a little bit, and then Lindsay will go ahead and close it out and show us. Oh, okay. The majority today is finance. So fellow accountants and finance folks. And then we have a nice mix of combination of the above, which is nice as well. So it's good to see. And some committee members, welcome. And as always, thank you for your service.
And then I'll take the last poll question. And this is not a gauge of your age, but merely your experience, because I have more than 20 years experience, but having started on my 18th birthday, that makes me the tender age of 38 years old. But how long have you been working in your current role? Okay, and it looks like the majority of are similarly seasoned to Kinman, Bertha, and I, and that you've been doing this for a little bit longer than a minute and a half, with over 40% of you with more than 15 years experience. I'm going to transition into some of the topics today now that we've got a better sense of the audience. I think the reason that we thought that this was a timely presentation on a critical topic to tackle with our friends at Moss Adams has to do with the volume of litigation that we're seeing in the retirement plan marketplace. When you look back over the course of 2016 to 2022, we have seen a significant uptick in the number of class action litigation suits brought against retirement plan sponsors and fiduciaries. Most of those are fees, and this is what we're showing you here, is this notion of your plan participants bringing suit against a plan sponsor because a perception that the fees that they're paying for retirement plan administration investment products is too high. We've seen that certainly extend into 2023. And while we're not going to get into it in great detail, there is growing concern, frankly, and I know that a number of you are within the healthcare sector and probably all of you sponsor some form of health benefit for your employees, that the class action litigation that we're seeing on the retirement plan side may soon expand over to ERISA-governed health and welfare plans, where the notions of fees and fee reasonableness is also a potential source of risk and potential litigation opportunity for plans or for litigators on the class action side. You know, if we look at the next slide, what we'll ultimately look at is that there's a number of entities when we talk about what the best way to generate, produce retirement plan governance structures that help deliver good outcomes, but also protect critical members within your organization. I think it's important to kind of categorize the different entities within the retirement plan landscape. So at various times, we'll talk about certainly the board of directors. So at least in many organizations, non-for-profit organizations, and Kinman will get into this, use volunteer boards. These boards are mission-driven boards working on healthcare, education, social services, the arts, whatever it may be. They're donating their time and expertise. We certainly don't want to be in a position where we're exposing those volunteers to critical risks relative employee benefit plans. We have and should have in any institution retirement plan fiduciaries, people within your organization who are charged with the governance and the execution of their responsibilities to retirement plan participants from a fiduciary perspective. Those are retirement plan fiduciaries. Will help define those. Clearly, there's plan participants. So while I think it's a misnomer that plan participants bring suit against plan sponsors, ultimately what happens is that litigation firms find participants who create a claim against plan sponsors. So certainly being aware of what our liabilities and risks are relative to that population. The Department of Labor is a critical component here. We're by and large dealing with plans that are governed by the Employee Retirement Income Security Act. And the Department of Labor is the governing structure for that set of rules and regulations. So there is legal liability relative exposure to the Department of Labor. Legal counsel, clearly, if we get into a situation where we are having to defend the suit, they'll be involved, as will likely a fiduciary insurer. I'm assuming that the overwhelming majority of the organizations on this call, either as a byproduct of their D&O insurance or separate insurance, carry some form of fiduciary protection for their organization. And then last but not least is the investment consultant, ideally an organization that is sharing or has some of the same legal liabilities that the other plan fiduciaries do from an operations perspective. In transitioning really to the next, I think it's important to define under the Employee Retirement Income Security Act. I talked previously about this notion of retirement plan fiduciary committees. And I think there are some organizations that still don't necessarily have formal committees that have been delegated by the board. I think Kimman will talk a little bit about the importance of governance and delegations to this particular process. But whether you have a committee or not that is responsible for the governance of your retirement plan, the Department of Labor has solved that problem for you in stating that whether you have a committee, whether you've appointed somebody, every retirement plan has a fiduciary. And the Employee Retirement Income Security Act, or ERISA as we'll refer to it, defines a fiduciary as a person who exercises discretion over the management of the plan or the plan's assets. And that is a broad interpretation. So it is likely not one person. It frequently may be a large number of people within your organization that have some involvement in the process of either selecting or deselecting investment options that are used by your plan. Renders investment advice to the plan or participants for compensation. So if you have outside organizations that are helping with the investment review process, hopefully they're serving in a fiduciary capacity. And as a result, would be considered fiduciaries under the definition of ERISA, or has discretionary authority in the administration of the plan. And I think this is where ultimately we end up broadening the pool of potential fiduciaries pretty significantly. So if you have a benefits person, an HR person who's interpreting eligibility for benefits under the terms of your plan, because we've got an XYZ type of an employee, are they eligible or ineligible? That is operating under the administration of the plan and exercising discretionary authority in many instances. In addition, within your plan document, every plan document is required to define at least one fiduciary that must be named. They can certainly delegate their responsibilities, and frequently do and probably should as a byproduct of any good governance process. But the plan document defines that organization. And what we find increasingly, and across a broad variety of plan sponsors of different sizes and organizations, is that frequently the organization or the plan sponsor is defined as the fiduciary. And the challenge with that particular utilization of the plan document terms is when we name the organization as the fiduciary, effectively we're naming the board of directors as the fiduciary to the plan. So if we're going to do that, the importance of the delegation topics that we're going to go through, I think, is going to be highlighted further in today's presentation. So as we get into retirement plans, I do think it is important to define the different types of activities that organizations have with regard to their retirement plans. Not everything your organization does with regard to your plan carries the risks that we will talk about subject to the Employee Retirement Income Security Act, or ERISA. There are two really types of fundamental activities that plan sponsors take in coordination of retirement plan benefits. The first are what we define as settlor activities, SETTLOR. Those are decisions that are made effectively by the organization to start a plan, to terminate a plan, and issues relative to the design of the plan. So when we look at our obligations under ERISA from a fiduciary perspective, it is the job of your fiduciaries to operate exclusively in the best interest of plan participants and their beneficiaries. Ultimately, as an organization, you do have to make decisions about how to design a plan that meets the compensation needs of your organization. How you design a plan is not a fiduciary function. That's a settlor function. If you fundamentally run into economic hardships, so 75% of you serve in a finance capacity, you're making budgets every year, you're having to operate against those budgets. If you find yourself in a position where you're no longer able to continue to fund your retirement plan and need to reduce benefits, that is a settlor decision. Frequently, the same people that make settlor decisions are also the same people who are charged with making fiduciary decisions. It is important in your documentation process, however, that you are able to demonstrate that you know the difference between the two. When are you serving in a settlor capacity? When are you serving in a fiduciary capacity? And developing your documentation in accordance with that. So with that, I'm going to hand it off to Kinman to talk a little bit about governance boards and how effective organizations help draw out and define who's responsible for certain activities within your organization.
Thanks, Eric. I think you kind of setting the foundation for this is super helpful, and as three of us can present about this topic, we're definitely not just talking as service providers, as auditors, or plan consultant advisors, but we're also talking as board members and even compliance or audit committee members, because all of us sits on boards as well. So a lot of our perspective is shared in both lenses to help everyone to kind of put into perspective, the risk factors and things to consider. So we start off with just governance, right? Governance is super important, especially if we are talking about the role of a fiduciary and looking at the risk assessments, and also looking at all these plans itself, given the environment that we are in. So a lot of governance is looking at not just policies or systems or structures or processes, but a lot of it is the framework that is put in place for the governing body, and in most cases, the board of trustees or board of directors, that helps ensure leadership, right? Those your C-suite and also the delegates make sound decision and then also take appropriate action to ensure that the organization or the retirement plan is effective and accountable in all matters. And what we mean by this is, how does all these elements come together to ensure strong governance? And on the next slide, we kind of talk through, what is the board's role and responsibility in general when it comes to this? On the next slide, we kind of cover, the essentially 5 elements of the roles and responsibilities of a board of trustees, or board of directors. The framework. The role is to establish a strategic and effective framework that is aligned to what the organization's mission is, the goals, the strategy, the vision. A lot of strategic planning goes into this place. A lot of times it's a 5-10-year plan that you're looking at it, and then looking at specifically on an AOP or KPI measurement as well. And then the second part is setting a direction. This is where a specific KPI is being set for each year or each quarter. And then a lot of times, an annual operating plan that kind of determine how you function. Every organization that's successful has that in place, so that then you can then set policies, right, or processes to create the direction of the organization. The next part, I've kind of mentioned about KPIs and plans that's in place, is to ensure accountability. How do you keep everyone accountable all the way from the board level, right? We, as board members, you have to be accountable. Leadership has to be accountable, and of course, as you kind of further go downstream, accountability is key to ensure that everyone is following, is moving in the same direction, or in the direction that we want the organization to move in, to meet the strategy, to meet the goal, and to achieve the mission and objective of the organization. And then the fourth item has to do with just what we call goodwill, support for the organization. A lot of this is more accountability on how the board does the support, and some of this might be financial support, but also expertise support. So some of us might be financial experts, or legal experts, or even benefit retirement plan expert in providing support, guidance, and also advice to ensure that the organization is being properly supported in the direction that it wants to do. And then finally, the value proposition of organization essentially drives the organization forward. And the board does need to model that, right? Because you have tone at the top, ensuring that the value is consistent throughout the organization in kind of moving in this manner as well. And one of the items that always comes up on the next slide is what we call the board sweet spot, right? We see this all the time as we talk to either the board of trustee, board of directors, or we talk to management. A lot of times they're like, the board is too in the weeds, or sometimes the board is too high level. It's always I'll say a juggle on when do you get into the details, when do you stay on the 100 feet level, looking strategically on the strategically and holistically as well. The sweet spot is always in the middle of that, and a lot of it will pivot depending on what the organization needs at any point in time. So what we always say, the sweet spot is in the middle, but you're able to kind of move as needed when situations or circumstances happen, or even situation happens that warrant more direct involvement of board members or committee members as well. So this is always a good reminder of where we should be as board members, and also kind of help direct the board as needed. If you think that we need you more hands-on, let them know, because a lot of times some boards are like, we don't want to control all the day-to-day operation, but if you need guidance or help, I think it's always helpful to also ask for the guidance and seek advice as well. On the next slide, we talking a little bit about what an effective board of governance should focus on, and this also kind of goes into what Eric kind of mentioned a little bit earlier about the settlers and also the fiduciary. And on the board level, a lot of the focus is on governance, on directing and guiding, and focuses on outcomes and priorities, right? And this is where what we mean by this is focusing on the big picture, deciding what, requesting information so that you understand what the situation or circumstances is, consider the issues, and then creates policy. And a policy, which we'll talk a lot more detail later on, is so important that the board focuses on, helping to craft the policy and review and of course adopt and approve the policy. A policy is a great way for the board to ensure consistency of the outcome and also focus on the management of the priorities as well. And then, reviewing plan monitoring process, that's part of the accountability factor, as we've kind of mentioned. The contracting of executive director and CEO, that's where the appointment and also assessing the CEO, who is top of the organization, is a key part of that role as well. And of course, budget. We all love the budget, especially in the accounting finance space, but approving and reviewing budget and ensuring that the budget is adhered to is also a key part, and also monitoring it as well, right? The accountability part, which kind of essentially flows through to how executives or the CEO or C-suite will then respond to each of these areas that we work with. They are determining how to operate them, how to implement them, and how to provide those information so that the board can assist in providing guidance. So this is where an effective board could kind of focus on the right thing, while management and the executive team could aid in that process as well. And then on the next slide, we'll also talk a little bit about governance habit that we have kind of look at, where these are some of the I'll say best practices or lessons learned that we all have seen and a lot of our colleagues have seen, and these are things that it's a good reminder of when you're thinking of yourself as board members, or you're looking to your board members' job, it's like, what are good effective governance that they can put in place, or you can put in place as board members, is to think and act strategically both on the short term and the long term. The second item, shared constituency. This is very important, especially on the fiduciary side, where you're looking at, what are all our stakeholders need, not just what the organization need, but what does, our retirement plan participants needs and their concern as well as it relates to a retirement plan. Looking at honoring the board and staff partnership. It's always helpful to have a great working relationship and a partnership with the board, and staff members are always collaborating in providing information, reviewing information, and making a lot of this decision making together. It makes it more efficient versus in some ways what we call combative environment, where there's a lot of push and tug that isn't always productive. So a lot of those it's definitely relationships that can build on. And then setting clear rules and procedures. That's where my colleagues Bertha and Eric will talk a little bit about meeting best practices, because especially as you have board meetings or committee meetings, what are the rules and procedures to have efficient meeting and also well-documented meeting, because those are very, very important. And then the last thing that I'll highlight here is the evaluation on the board as a whole. It's always helpful to self-evaluate the board, but also seek feedback from the management team on how the board is doing and assisting them as well, because a lot of times there might be gaps or areas where the board could be more effective, or could provide more guidance, or even add to their members so that there's more expertise as well. So those are some of the areas that could also be enhanced for the board to be more effective and in the governance work that they do. And then my last slide on just board responsibility on the next slide is just essentially talking about general board responsibility that I just want to remind on, because this will feed into the next section, is we are ultimately responsible to help manage the financial affairs of our organization. A lot of that I've talked to about controls, the processes, reviewing auditors or plan advisors. If you have an internal audit group, reviewing the plan around that, and then assessing what's going on there. The second item, the governing documents. There's so much governing documents, but it's important for the board to be aware of it, especially if you're charged with fiduciary of plans and the organization. You ought to know how the organization is governed, but also the policies, the processes around it, which is also a key reason why the board ultimately approves all policies of the organization that is being that procedures are developed from. to run the organization. I think I talk a lot about performance management and also accountability, and monitoring that is a key process to ensure that there's always a feedback loop to ensure that the organization is moving forward and keep to its goals and vision as well. And I've already mentioned a lot about this, about the fact that policies are key to the organization, and the board and the respective committees role plays a key part in this. And these are things that doesn't only just approve once and set it aside. It's also reviewing it and improving it and updating and revising it and when things happen, or even just on a pretty frequent basis as a best practice.
I'll jump in.
Yeah.
Yeah, I'll jump in here. Retirement plans, my favorite. But we thought we'd share some of the things that are a little unique about retirement plans. And we've shared some of this or alluded to it up to now. But one of the main things I think, sometimes organizations forget because the plans are sponsored by the company is that the plan is a separate legal entity. So we do have to remember that when it comes to governance. And as Eric shared, the slide of everyone, like the universe of plans and involved in fiduciaries, the realm of it, the plan is a legal entity in and itself. So it does need quite a bit of its own governance and its own documentation. And we're going to cover that today as well. Wanted to mention that unique aspect. So, in the absence of any committee or where the board has not delegated its authority, the board is the fiduciary. I think Eric mentioned this too, so I wanted to mention it here because it extends to the retirement plan. If there is no specific governance committee set aside or established for the plan, then the board is naturally that governing body. And I don't think most of our organizations would want that, because the board is high up and is not really in the details. And clearly the makeup may not be optimal for overseeing retirement plans. And then the other couple mentions I wanted to remind here is the governance extends to plan administration and investments. The investments are the majority part of the plan, as we know. Everyone's saving for retirement. So, naturally, if you look just at a balance sheet of the plan, the investments are the most, the biggest part, or the entire, plan assets. However, so the plan governance extends to the operation as well, and not just the investments. So often we see that a little lopsided. I don't know if Eric probably sees that too, where it's like everyone is focusing on the investments and how the market's doing, but they miss the plan administration, which involves, amendments, plan operations. Are we in the good with the Department of Labor? Do we have any corrections we need to make operationally for something that the plan, may have done in error and not in accordance with its plan documents? So there's a lot of administration that needs to occur. Did the audit get done in time? Does the auditor have any findings? But the investments, again, do remain a major part, just not the only one. And we'll share, or Eric is going to cover the investment policy statement later. So that I added here for the investment policy statement and plan document, summary plan description. That's kind of all the documents, or a lot of the major ones that we want to, be considered in the governance. But again, Eric is going to do a deeper dive in the IPS later. And then this, I always liked kind of the snapshot of the do's and don'ts. And one of the biggest things, and Kinman alluded to this, is the document. We will always say that and remind clients. I thought it only applies to auditors. If we don't write what we did, it never happened. As we know, a lot of our reviewers and the PCOB, everybody will remind us. So I like to remind clients that if you don't document how you got to a decision, it's almost worse than getting to the right optimal decision without a track record. And I'll say that again, because the Department of Labor has been very adamant and clear about this as well, is they will respect your documentation on how you came to a decision, even if they don't agree with the decision, or the decision ends up being, hey, we picked this investment or this service provider, but this is how we picked it. The service provider ended up not working out or making a mistake. They will respect that more than you saying, I picked my golf buddy to be the investment advisor because I see her or them every day. That is just not good, solid documentation. So that's what I'm getting at here is document how you got to a decision, all the due diligence, collaboration, everything that you did, the questions, RFPs, all that good stuff. Acting in the best interest of the plan participants. Here's where we come again. The plan is unique. you are serving the participants. You have to act as if it's your own money, but you're doing it for them. And we're going to talk a little more about what that means. And then recognizing the universe that, again, Eric spelled out, so I won't reiterate that. The do's and don'ts. On the don't side, though, don't over-rely on your external providers for governance, meaning, yes, I think you have great providers. If Eric and Multnomah Group you're working with, awesome. However, they're not your governance committee or even an extension. So you are still responsible for asking them questions, implementing on how they said properly, or documenting how you even discuss with them and come to a decision. So the over-reliance isn't to say that you don't take their advice, but don't assume that they are part of your internal controls, because they're not. Don't overcomplicate the plan. I see this a lot of complications for plan provisions, The match is, 0.5% of this quarter's salary divided by 20, paid on the 5th of the month. If you don't need to, let's not overcomplicate provisions, because that only becomes harder to administer. Unless you have the force and, the knowledge, excellent. But overcomplicating plans without really understanding the benefits or getting the maximum benefits for your participants often causes more fiduciary nightmares and blunders. And then let's not ignore, last and not least, our recommendations. Probably some of you work with us or other auditors. We're not gotcha auditors. Auditors shouldn't be gotcha, but they do quite often have a lot of perspective and a lot of experience in the things they see. So they have a lot of best practices. And I often say sometimes we issue recommendations and walk away. Hold your auditors accountable. Go, hey, you gave this recommendation. What have you seen? What's best practices? When would you like us to see implemented? Can you check it again? So that, we don't have to wait till the next year's audit to make sure some things have been put in place. So do more closely with your auditor in that respect. Eric, I'll kick it back to you.
Yeah, I think Bertha made a great point. I think since 3/4 of you are on the finance side, you probably work collaboratively with others in your organization on plan design and budgeting issues. I want to get back to this notion of complexity is the enemy of efficiency and cleanliness of operation, because it's going to be contingent upon what I'm discussing here. But frequently what happens is, in the effort to try and not provide a benefit to a small group of participants that would cost the organization virtually nothing, we make the operation of the plan hard. So I would encourage you finance folks to go to your other colleagues and say, hey, I'd rather spend $5,000 providing a little bit of extra benefit if that helps ensure that the plan operates more cleanly. Because while funds and fees do end up typically being the primary sources for litigation risk, operational risk comes almost exclusively through the issues that Bertha just mentioned. So under ERISA Section 402, your retirement plan needs to operate in a method that's consistent with your written plan document. And this is where the overwhelming majority of organizations have struggles and frankly fail periodically. And I think that's okay. There are provisions to correct failures. But the more complicated you make the plan, the more likely those failures will be, and the more cumbersome the corrections will entail. So the written instrument is your plan document. You've got certainly pre-approved plan documents, and many plan sponsors use those documents. They tend to be tied to your record-keeping provider, where you check your eligibility, your compensation, your benefit match schedule, your eligibility. The challenge, I think, for many organizations is they want to run the plan a certain way, and the boxes in their pre-approved documents may not be consistent with how they want to operate the plan. If that's the case, then you need to be looking at individually designed documents, which again provide you more flexibility. Although again, the counterbalance to that being that sometimes more flexibility is bad, meaning that staying within the limitations of a more standard or easier to operate plan may be beneficial for your organization in the whole. It's really important that plan operations match the plan document. One of the things we do with clients on an annual basis is sit down, go through with the record keeper and look at whether there are issues that are causing us operational potential for error prospectively. This notion of making sure that the operations match the plan document, because regrettably in many organizations, regardless of size, the information about how the plan operates is something that's passed down like mythology stories of old, right? It's, well, these people are eligible, they get this. whether or not that is consistent with what's written in the plan document or not. Part of the audit process is hopefully helping to discover those inconsistencies. Ideally, you'd like to discover them before Bertha and her team discovers them. It's important that you audit those processes. Plan sponsors, obviously large plan sponsors, required under the Employee Retirement Income Security Act. And there will be the need to amend these documents over time. New rules, Secure 1, Secure 2, all the issues that came about as a result of COVID and the additional availability of benefits are all critical issues, both A, making those amendments, and B, making sure that we've communicated those amendments through SMMs or SPDs to plan participants. The next piece of your document, what I would argue is your document triad, is your investment policy statement. On the investment policy statement side, what you're trying to do is create a philosophical layout of how you will be reviewing investment architecture, performance, and measurement prospectively. I think there has been a tremendous amount written about investment policy statements. From my perspective, and certainly from the perspective of our organization, the investment policy statement is designed to be an instrument that drives process and drives philosophy, not drives decisions. We see a lot of investment policy statements that try and turn the investment selection process into a math game. If I have had X quarters of performance that is beneath benchmark Y, that means I need to replace my investment on date Z. And I think, regrettably, there's been academic studies that have revealed that having that kind of dictatorial investment policy process tends to drive lower returns to participants. What ends up happening is that we're selling products that have done poorly before they return to mean, going the other direction, adding products that have done well historically as they revert to mean, and driving underperformance over time. We've laid out what we think are the fundamental 6 elements of an investment policy statement, and maybe the most important, much like the other plan documents, the documents that Bertha and Kinman have talked about, reviewing these documents periodically so that you're aware of what the philosophy of the organization is, and that there is buy-in from the committee, whatever that fiduciary governance committee is, related to the investment process. And the last, and certainly the not least important among the triad, is this notion of a committee charter. And this gets really back to what Kinman was talking about earlier, is in most cases, what ends up happening is that the board ends up delegating whatever fiduciary responsibilities they have under the terms of the plan document to another group within the organization. Could be management and other employees, could be members of the board and management and employees. There are many ways that you can run that process. But to Kinman's earlier point, this is a policy document that says, hey, we think you as the fiduciary committee should be worried about these issues and be adhering to this set of responsibilities. The board, is making the delegation because the plan document has laid them out as being the responsible party. However, once they have laid out that delegation, just like with the other activities that Kinman was talking about earlier, they have an obligation to monitor it. Anytime there's a delegation, there can't be a one-way delegation without that level of oversight. The same way the board monitors their delegation to the CEO, monitors their policy delegations to the organization. If they are going to be the party responsible from a fiduciary perspective for the plan, which is very, very typical, and they're going to make that delegation, which again is very, very typical, there needs to be some methodology. What you would not want to be in a position where there is litigation, and the litigation is against the plan fiduciaries, and ultimately the board's made a delegation to the committee, and now you have your board members trying to explain in deposition what their oversight process is or was to the retirement plan, and there is very little of it and almost no documentation of how that process evolved over time, and when, if ever, the board has executed on their oversight process by making changes or receiving information about the operation of the plan. There are things that a good charter should have. I would argue that most good charters should provide indemnification. So for those of you who are aware of the risks subject to serving in a fiduciary capacity under ERISA, the risks are real and they pass through to the individual members. I think it's certainly reasonable that an organization would indemnify anybody that has those risks within the charter document, again, making them subject to the insurance protections. It should lay out what the roles and responsibilities and ultimately how members get on and off of that particular committee and group. But that process that we see lacking so frequently is some method of having the delegated retirement committee report back to the board what they've done, how they've executed on their responsibilities under the charter. So let's get into the documentation process. I think, Bertha talked a lot about document. The Employee Retirement Income Security Act is a process responsibility, not an outcome responsibility. So your obligation, whether it's selecting an investment, a record-keeping provider, making determinations, is not that you guessed right or even that you had a process that generated the right outcome. It is that you have a documented process that you have adhered to that is reasonable and subject to all of your responsibilities from a fiduciary perspective. So everything you do through this process really gets to having the documented process of gathering all the relevant information, that you've analyzed that information, that you've had discussions about and questioned the people that you may be working with who are making recommendations, that you've met, you've deliberated, and that you've arrived at a decision, and documenting every step of that process. One of the things that we do for a number of our clients is draft, at least make the first draft of the client meeting minutes. And it's important to understand that those minutes have critical responsibilities, and they really have, I would argue, 4 different audiences. One is the members of the committee. It helps them understand, remember, what did we talk about 3 months ago? How did we get to this decision? What did we say we were going to do and did we do it? So that measurement of our activities. The second is to the Department of Labor. When the Department of Labor comes, they are going to ask for your minutes. And I think you are going to want to be able to present to them a clean and consistent set of minutes that helps demonstrate your fiduciary process so that they get comfortable with it in the event of an audit. The third is ultimately potentially a class action litigant. So if we end up in a situation where we are having to defend a class action case for fees, funds, or whatever else, ultimately we're going to be asked to reveal those documents and making sure that we've drafted them in a way that helps, again, demonstrate the consistency and the excellence of our process. And fourth is ultimately that board of directors that made the delegation. Are they going to be looking at every set of minutes? No. But should they have the ability to look at a set of minutes and make sure that they understand and are comfortable with the process? Absolutely. So having the expertise to document your meeting in such a way that it meets the needs of all 4 of those audiences, I think is a critical skill and helping reduce and hopefully eliminate some of the fiduciary risks and liabilities that you may be subject to. So with that, Bertha, it's your favorite topic. I'm going to hand it off to Bertha to talk about retirement plan audits.
My fave again, because we were going to kind of put this somewhere, and we thought this is a good place in the presentation because you've heard quite a bit about governance to date, and we have a lot of still good information to cover. But the audits, for those of you who've gone through, hopefully this is a little bit of a review, but financial audits of the plan, we're looking at the plan, we're looking at the trust, which, holds the assets, and then the plan provisions, which we've been talking about, all the plan documents. And as Eric mentioned, the audit has a compliance to it because the Department of Labor requires the audit. So there's clearly that compliance of, is the plan being operated in accordance with the plan provisions? And is the reporting reflecting that as well in the financial statements and the footnotes? And then there's, of course, the financial standards and auditing standards that we abide by. So it is kind of a little mixture, and that's often harder for finance folks to comprehend than non-finance folks, which is kind of interesting because we'll look at a sample basis. I mentioned the areas of emphasis here that we look at. There's, the contributions. It's basically the ins and outs of the plan. And we do look at them on a sample basis. An audit's never 100%. This is why sometimes, there is errors, there's things, and that we are not an extension of the plan sponsor's controls because we're never looking at 100%. Unless, it's a consulting project or there's other risks, but rarely we're looking at 100% of the universe. So this is why we assess risk. Most Adams, we are risk-based audit methodology, but we do look at the risk and we assess where the risks are and look at controls. For example, eligibility. What is the risk of improper inclusion, exclusion? And we audit to that based on the plan's definition of eligibility. What is the risk of someone getting in there or not getting in there timely? And then what are the implications? And then the audit areas, like I said, the ins and outs of the plan. So we do look at all of this. And, we've been talking about documentation and this, I want to put another plug in for how important documentation is, because oftentimes the plan is written in a way and it's administered in a different way. It's hard to, when I've talked to so many clients and, I've seen that they have honestly tried to do their best and are administering the plan in a way they wanted to. That was their intent, to give those, include that definition of comp or include that percentage of match. But the documentation does not match up in the plan document. So when we look at it, also the documentation you do in your minutes and plan review covers your intent. And sometimes it's easier to go, well, the intent was this, and we're going to go correct this. Even, we've set precedents in this. And so maybe it's a plan amendment and let's, work that way with the DOL or the attorneys. So it's really also important in that sense to know what you intended for the plan participants to experience. So that's kind of an audit. Definition of comp, these are all also hot buttons of the DOL. I like to refer to them because the Department of Labor is looking at timeliness. Definition of compensation still tripping up folks. As we know, it's important for what compensation you use for employee deferrals or match or any other contributions. And that often is not, calculated properly, or there's just changing codes. It's complex. So we find, that is usually a challenging area. Planned mergers, I'll just have here, please reach out. Those are pretty complex. There's a lot happening in planned mergers and how you report and audit through those and reflect that activity. So that's the retirement plan audits, and then I'll kick it back to you, Eric.
We've got organizations of different sizes on the call. I think what's astonishing really is your risk of being a litigant is obviously correlated to how large the plan is. And the larger your organization, the higher those probabilities are. If you're in a ERISA plan with more than $1 billion in assets, statistically, you've got about a 7.5% chance of being sued in any given year, which is astonishing. And frankly, that number probably gets higher to some degree because they typically don't go back and hit someone they already hit, although that isn't entirely true. There's some organizations that have now been the subject of multiple class action suits. If you're in a ERISA plan with 500 to $1 billion, closer to 3 to 5% chance in every year, and it certainly shrinks from that point forward. I do think, moving to the next slide, there are some issues that if you're looking to help mitigate risk, these are issues that you should be intimately aware of. Procurement recency. It is a pain to change record keepers, but it is a huge risk not to have a relatively recent procurement process. And I'm talking within at least the last 10 years, preferably sooner than that. Ultimately, this is an easy path, and there has been actually cases that have gone through where the judge has decided in favor of the plaintiffs based on this recency issue. Method of fee calculation, I think increasingly what you're finding is using revenue sharing to pay providers is becoming more and more difficult from a process and procedure perspective to defend. It is not on its face a problem, but it certainly increases the likelihood of you being the target of litigation. Target date and performance suitability. I think the Department of Labor is certainly aware of utilization of target dates. And when you're a class action litigator, you're looking at big pools of money. One of the largest pools of money is within target dates and making organizations defend their process there. Managed account utilization and suitability. This is areas where we see both conflicts with record keepers and advisors who are using advisor managed accounts. There are heavy fees frequently with these managed accounts. And I think you're going to see a huge wave of litigation over the course of the next year in this particular area. Share class costs. So most of you, many of you, maybe all of you are tax exempt organizations. We have not had the ability to use things like collective investment trusts, but even within the last year, pardon me, the last 2 weeks, the House passed a bill that would allow 403B plans to use lower cost collective investment trusts, to the extent that ultimately the Senate also passes that bill, which I think they will at some point, and it will be signed by the president. That will open a huge wave of potential changes to investment structures to reduce costs. And if you don't avail yourself of those opportunities, you likely have increased your litigation risk. And last but not least, is this notion of passive versus active investments within plans. If you have had the opportunity, and many of you may have, of concluding or completing one of these underwriting processes for fiduciary insurance, they're asking a lot about how many of your investments are passive versus active. What is the cost structure? All of these areas, depending on where you are within your organization, create or at least increase the likelihood of you potentially being a target. In moving to the next slide, I do think it's important to point out that if you are a smaller plan sponsor, let's call it under 500 million, your risks, I think, are largely attributable to Department of Labor activity, meaning that they still have risks, but those are risks that you likely can settle with the Department of Labor. If you're in that 500 million and up category, the Department of Labor is also a risk, but maybe the more expensive risk to your organization is having to defend potentially a class action suit. I do want to get into some best practices as we kind of get into the conclusion of this process, and Bertha and I can talk about them. We've talked about the key elements of a plan, the written document, the record keeping system, and all the documentation that comes along with it. But I think it's really important to critically outline for everyone here the responsibilities of being a fiduciary. And that is to act solely in the interest of plan participants and beneficiaries, and providing benefits to those populations, to carry out your duties prudently. And that is a much higher standard than you might find in other activities outside the retirement plan realm. Following the plan document, to Bertha's comments earlier, you can do things that are permissible. If you're doing things that are legally permissible but don't match your plan document, the bad news is that is a fiduciary breach, despite the fact that they would have been legal had you have written them correctly. Ultimately, diversifying plan investments, and maybe most importantly, from a litigation perspective, paying only reasonable plan expenses. I want to highlight this because I think it's an issue that pops up in non-for-profit sector tremendously, right? With volunteer boards, you are likely selecting people that have expertise in various issues, could be investments, could be audit, could be human resource policy strategy. We are finding too frequently, especially within smaller nonprofit organizations, where members of the board are serving an active role, potentially as vendors or providers to your retirement plan. And while on its face, that may not be a fiduciary breach, you have created conflicts that will be very, very difficult for you to document your way out of. I understand that those are people that are committed to the organization, that understand your philosophy, and that you want to reward them potentially economically for their contributions. But by doing so, you've created risk for both them and your organization. I think it's important to point that out.
And Eric, I would probably add the first two are the hardest when I've talked to members, committee members, oversight committee members. It's hard to put yourself and remember that we're really trying to have these plans. I always say we're trying to save us from ourselves or save your employees from themselves. And so they can, put away money for their retirement. We're trying to build that, healthier, more just, financially set and secure aging generation or older generation, and whenever they want to retire at whatever age or whatever, they want to do. So you kind of want to make sure that you are really acting in their benefit, understanding your demographics. Is the company older? Is it aging? What, who's retiring when? What's the longevity of my employees? Don't be, bashful of diving into some of that so you understand the organization you're serving, because I feel that's usually the hard part. Members go in and go, well, I just want to, invest in this really great investment. Well, is that the right investment for your plan participants? So that's kind of one of the, they find those kind of harder areas. But I go to this one because I like this slide too.
Sure. So in looking at committee structure, I think it's important just to organizationally understand that these fiduciary obligations are on the rise, and that your committee is going to be required to make some difficult strategic decisions. Because of the fiduciary obligations and the litigations, The areas that the committee is going to have to wrestle is that a lot of people, vendors, record keepers, brokers, consultants, others, are going to come pitching products, and frequently those products and solutions are conflicted. And your job as an organization is going to be to sort out those conflicts and trying to determine, back to Bertha's earlier point, what is in the interest of the participants, not what is the hot topic, what are my peers doing. Frankly, I think that's one of the traps that a number of organizations fall into is, what are my peers doing? Well, many of your peers are making bad decisions. I think so. Using peer benchmarking as being the defining characteristic of your organization can lead you to make the same mistakes, frankly, that your peers have made, and ultimately some of those mistakes have caused them to end up having to sit in the deposition chair.
Yeah. And that you're looking at the overall benefit. I mean, that's a great point about peers, Eric, because you don't know how your peers are providing an entire benefit package. And often I'll get a really detailed question from a client. Well, I think their 401k plan, the match is 2% more. This is different. And it's like, well, do you understand their entire comp package, the entire proposition for the employee? They might be doing this in this lane, but they might have a deferred comp or some other package here that's helping the employee still get closer, right, to their goal of good financial health. So you want to be careful where you're comparing apples to apples and not just looking around and reading highlights about your peers.
And I think if I said there are 5 things that philosophically your organization should look at from a best practice perspective, knowing your participants, to Bertha's point, what do they need? How do they interact with the plan? Target zero waste, right? If you're looking at litigation risk, it's more than appropriate to pay for good service. And if that service is providing benefit to your employees, that's reasonable. And I think the Department of Labor has been very clear with that, as have the courts. But if you're wasting participant resources, you will find yourself in an uncomfortable position at some point. What I'll say is that I think every organization from a retirement plan perspective finds that small incremental change really drives outcomes. You don't have to reimagine your retirement. Defined contribution plans have worked, continue to work very well. Small tweaks, measuring, did the tweak help generate better outcomes? And then adjusting strategy accordingly is very, very effective to helping deliver the best retirement benefits. Empower people to act. And I think this really gets to the delegation notice. I do think that the question of Kinman raised of, are we in the weeds or are we strategic? I think boards need to empower the people closest to the participants to operate in a fiduciary capacity, and empowering them to do so in ways that make sense, and be transparent. If you feel like you have to hide something, then you really should probably re-examine the decision that you feel like you need to obscure from a participant perspective. And then last, because I know we're getting to the very, very end, and then we have a last poll question, is really building on kind of a strategy of improving plans. The basics is really getting your retirement plan in place, getting the delegation process and the documentations that we've talked about. Process development is looking at your engagement, looking at retirement savings health, taking action, finding the right provider network that can deliver benefits and services to your participants appropriately, making sure your funds and fees are in line. And then once you've built those processes, then you can get into things like aligning your plan design with your human capital process, taking a look at retirement income, taking a look at broader retirement health and financial wellness issues. But all of those things can really only be done safely if you've built a good governance foundation beneath you.
Absolutely. And to our last polling question. Lindsay will open that up. What topic discussion point was most helpful or interesting to you? So no pride of ownership here, right, Eric and Kinman? But whatever.
There is. If you say it's fiduciary versus settler, though, I'm gonna question. I'm gonna have to go back and talk to those people individually.
I think you also have all our contact information. We'll all be open to any questions or anything. I know we're out of time, and I don't know if Lindsay has some housekeeping comments, but we most certainly are around for any questions or anything, comments that you want to share afterwards. Oh,
one out of the 55. I like it. One fiduciary versus settler.
That was not me. No. That's great. That really shows a nice, kind of a mix of topics. Wonderful. Glad everyone enjoyed it. Lindsay, do we have any parting words, or we can close our session?
No parting words except to say that everyone will receive the recording and the slides in the very near future.
Thank you.
Thank-
Thanks everyone for joining us.
Thank you, everyone. Have a great day.
Great
Thanks.
day.